So, good morning. Hello, everybody. Welcome to this FX Street webinar where we're going to talk about support and resistance. And I know you actually just had a webinar on that before, which I wasn't aware of when we planned this, but hopefully you'll find some value in this as well. And what we're going to attempt to do as with all of our webinars, we just really want to give you an idea of how we go about trading and what we do in the markets. We wouldn't present to you something that we don't do ourselves. So every time that we're here and presenting to you, it's really just sort of trying to give you a view into what we do day in, day out. Okay. So before we start, as always, the little disclaimer here, the content of this webinar is not for investment advice at all, and it should be used for educational purposes only. Obviously, you're advised to go away and do your own due diligence on any trades or anything that we may talk about within this webinar, or any ideas and everything. Go away and do your own due diligence. It's not investment advice. So we've got that out of the way. Again, a little introduction as to who I am, just in case there are some new people here, and for those that have been here before and seen me before, welcome. Hello, everyone. My name is Alex Ong. I'm the co-founder of a website called Traders Corner. It's a website I've run with my brother for the past couple of years. We write articles for FX Street, a couple of the magazines, and some other websites. We do a lot within this industry, and of course, and most importantly, we trade ourselves. So if you're interested in anything, hop on over to the website, or you can follow me on Twitter, whatever you like. I just got to try and trade is saying that the sound keeps cutting out. So before I go any further, is the sound cutting out for everybody? Or is it just, no, everybody's okay? Try and trade, is the sound any better for you at the moment? Perhaps maybe try logging out and logging back in. Okay, wonderful. So this webinar, we're going to talk about support and resistance. Now, before we go into that, we need to talk about the market, the way the market naturally moves. And I want all of you guys to understand that the price, it never just moves in one direction, okay? It doesn't go from A to B in a straight line, and that's where things like support and resistance can come into play to really help us, pick the best trades to get into. As you know, typically speaking, we don't like to range trade as much. We prefer trend trading. So when we're talking about support and resistance, we're talking about entering on pullback. So for example, if we're in an uptrend, we're going to be buying the dips. If we're in the downtrend, we're going to be selling the rallies. Now we always, when we talk to our members about, their trading and how they can improve, the one constant sort of message throughout is to wait for the best trades. And the best trades are those trades where the price is pulled back to an area where you would expect it to turn around. Okay. And I really want you guys to own that. So when you are looking to get into your trades, if you're going to trend trade and swing trade as we do, you want to be taking your entries from areas of the chart that are obvious. Now, yes, that means you're going to leave some moves on the table, and that's going to be frustrating, but it will also keep you out of some not so great moves. Okay, so if you want a higher strike rate, then, take my advice, do what we do what our members do, and sort of trade only the best setups. And the best setups are those setups which are from predefined levels. Okay, so a swinging market, as you can see here, obviously this is perfect PowerPoint slide, but we're looking for higher highs and higher lows in an uptrend, and lower highs and lower lows in a downtrend. So this here is a swing high, swing low, swing high, swing low. These also can be seen, as you'll see in later slides, as that this would be a resistance point, this would be a support point, this would be a resistance, this would be support. Okay, support is an area, a very clearly defined area where the market, has been sold off from, it comes down to a level and it finds sort of like a floor. Now, if it doesn't reverse immediately, it at least finds it very, very difficult to get through, and it will consolidate along that level. Okay, so that's what support is. Resistance is sort of like a ceiling in the market. So the market rallies up to a point, and it gets up to that point, and it can't get through it, and it will either reverse completely or it will consolidate around that point. And we're looking for the most obvious levels. Okay, everything that we do when we're trading, we need to be trading on the side of the market where the big money is. Okay, so there's no point in us trying to find these hidden levels of support and resistance that don't exist to the rest of the market, because that goes against everything that we're doing. What we're trying to do is find the areas where the rest of the market are paying attention to it and sort of ride on their coattails. So why do I like support and resistance? Well, first of all, it's probably the most basic but yet effective form of technical analysis. Everything that we do with our trading is based around support and resistance. It is the key technical tool that we have. They can be accurate on 5 minutes. They're more accurate the further you go out, but you can trade intraday levels as well. All right, so definitely on the 5-minute chart, you can see intraday levels of support and resistance. Most market participants acknowledge these levels, okay? And as I was saying before, it's a very effective form of technical analysis. If you held a gun to our head and said, you have a chart and one tool, what would it be? Without a shadow of a doubt, it would be a horizontal line. That's, you know, we feel we could be profitable with just literally a horizontal line and absolutely nothing else. So that shows you the belief that we have in support and resistance. Now, just going to the question, Jack, you had about, are these levels accurate on a 5-minute? Yes, they are. As you can see here, the bigger the time frame, the more important the potential support or resistance level is. So on the shorter term time frames, you can definitely trade from those levels. You just got to wait for a reaction. And this is the secret from our personal perspective. The secret with support and resistance is not to try and predict what's going to happen. Okay, you can anticipate where the market will turn around, but you then need to react to price action. You need the market to tell you that, okay, this level here, we're paying attention to this level, and therefore you can pay attention to that level. You don't want to just, let's say, for example, you're looking at a resistance level. You don't want to be selling that resistance level as the price is coming up into it, okay, because what you're trying to do there is literally stand in front of a train, and you don't want to do that. So we want to start selling when we can see weakness in the market. And there's no weakness in the market when the market is rallying. So whilst the market is rallying up to a level, you sit on the sidelines, you wait for it to show its hand. You wait for the market to stall at that level. And once it's stalled at that level and starts to roll over, that's when you look to get into the trade, okay? With regards to risk reward, as Yusuf just asked, risk reward, typically we like a positive risk reward. So we're looking for anything, well, obviously 1-to-1 is a minimum, but we like to have, you know, sort of like 2-to-1s on our side, because that gives us a nice warm fuzzy feelings inside that we can be wrong more times than we're right and still come out ahead of the market. Not ahead of the market, but ahead in our account. Okay? So as I said, price reacts to these levels, so movements can be anticipated. So what I mean by this is that when you look at your charts, you need to do your analysis either the morning before you're about to trade or the night before, and literally put these levels onto the chart. So you almost build a trading plan. So you almost have a plan in place so that you know when price gets to this level, if it then gives you the sort of shows its hand to you and indicates that it's going to roll over, then you can trade from that level. All right, so you anticipate the level that the price is going to react to, but then you wait for that reaction. All right, because one of two things are always going to happen at support and resistance levels, and this is something that's quite hard for some traders to get on board with. Obviously, price will reverse, which is what we're looking for. If we're in a trend and we're looking to sell the rallies, we're looking for price to reverse at these levels. But at the same time, at these support and resistance levels, price can break through with massive momentum. Okay, and what that ultimately means is you need to understand when you're entering into a trade, sometimes it feels like, you know, there's a little man inside your computer screen. It's just waiting for you to enter, and as soon as you enter, he goes against you or she goes against you. The reason that it feels like that is when you're trading from these support and resistance levels, as I said, there's only really one of two things that's going to happen. It's going to reverse, or it's going to smash through it with massive momentum. And the ones where it breaks through it with big momentum, they're the trades where you feel like you've literally just got into a trade and the market has completely faded you. Okay, so it's important to keep that in mind psychologically when you're trading these levels. You know, the market doesn't have anything against you. It's just the very nature of those levels. That's what's going to happen. Does that make sense to you all? So, those little gremlins. So one concept that I want you guys to really understand here, and that is previous support can become resistance and previous resistance becomes support. Because that is the core of our trading technique. Everything that we do, we're waiting for the market to break through a level, come back to that level, retest it, and sell off from that level, okay? That is you can't make this stuff up. You take a look at any of your charts and you'll see this stuff play out time and time again, all right? So what you have here is you have the market moving up, the market breaks through a level, it comes back to a level. That previous level of resistance now, you're looking to that level to become support. So you can actually, let's say, for example, you cover up, you don't know this price action is here. You still project this horizontal line into the future because that's where you're going to anticipate the market is going to come and turn around at if indeed it gets down to that level, at any time in the future. All right, that's why we said the horizontal level of support and resistance is the absolute best level because it allows you to project into the future where you believe price is going to turn around at. So then obviously you wait for the reaction. And this is an example of that in action here. So this is an Australian dollar chart for the year of 2009, pretty much. And as you can see here, it starts off at the low there. I believe that was around 80-ish or something, maybe below there, 60, 70. Breaks through that level, comes back to that level, treats it. So that was resistance there. It treats it as support. It comes up to a level, finds resistance. You put a line along there. You see it finds support here very, very briefly, rallies off from that level, comes back to that level, and again, that previous level of resistance is now support. The market breaks through this previous level of resistance, comes back to it, and where does it find support? At that previous level of resistance. Now, this is obviously an example chart. It's a little bit clearer on this chart to see than maybe some others, but this is just to illustrate to you what it looks like and how this stuff works. Okay, so if you're going to be patient enough to wait for the right price action, then you're going to be getting into the right trades. If you're deciding to trade from, let's say, like the middle of this chart here, where there's absolutely nothing for you to trade from, then you've only got yourself to blame when you get stopped out of a position. Okay, if you can wait for these levels where the market's broken through, clearly it comes back to a level that's very, very clear, and then you trade from that level, then you're going to start to stack the odds in your favor, and hopefully if you get enough of it in your favor, then you're going to be taking profitable positions, which over the long run will make you money. Okay, and you have to remember as traders that this really is a marathon. It is not a sprint. There's no prizes for the first person to get into a trade. All right, and we can't predict what the very next trade is. So every single trade, if you take it in isolation, is pretty much random. It's only a series of trades over a long enough period of time that you get to start to be able to see patterns and you start to see an edge play itself out. And that's very, very important to remember when you're trading. These are regular candles in front of you. Yeah, these aren't range candles, but we use them on range candles as well. It's just to give everybody an idea of this is sort of like a general support and resistance webinar. How about if a day chart is uptrend, but your 4 hours downtrend, which will you follow? Well, ultimately, the longer term time frame takes precedence, so you'd go with the daily chart, but you'd really look to see where you're at in the grand scheme of things. So, for example, this is a daily chart here, okay? This is a massive uptrend. You could look on a 4-hour chart and you could see this is a downtrend here. We would be looking for a reversal on the daily chart, and we could possibly look for like a 1, 2, 3 reversal, some sort of price action reversal on the 4-hour to get us back into the direction of the major daily trend. Does that make sense to you? Do you want that make sense? Hopefully. Okay, now for some shorter, some for the shorter term traders here, because it's not just about the horizontal levels of support and resistance. There are also psychological levels, which for you guys who day trade, you really should take a note of these levels, okay? For those who are day trading, you've got, 2 types of day trading and the third was just generally for everybody, okay? They are the round numbers, okay, and the daily range for the day trading. Who here day trades and who here pays attention to round numbers and daily ranges? Okay, it's actually very, very important to pay attention to these levels because they're psychological levels. They're not necessarily levels you can see on your chart, but they are there. Okay, so you know that if, for example, a round number, so let's say we're trading the euro dollar, okay, and we're coming down to the 12200 level. Okay, we know that the market is going to have some sort of an issue getting through that level. It will get through it eventually, but from a day trader's perspective, that eventually may mean whipping you out of the position a couple of times. So oftentimes it's better to wait until you get through that level and then look for your entry rather than try and trade into it. And the same goes for the daily range. Okay, you work out your daily range from, let's say, the last 20 days average true range. Everybody should have an indicator on their chart called the ATR. If you apply that to a daily chart, it should give you a value. Okay, and that value is sort of the average true range of that period in time over the last X amount of bars. And as I said, usually you use around a 20 days back. And what you don't want to do is start trading it similar to a round number. You don't want to start selling into a position if, let's say, you're in the euro and it's already moved 150 pips in a day. Why not? Because it doesn't make sense. Because you know that the average over the last 20 days was 140 pips. So you're expecting a lot from the market today to be able to continue 150 pips and continue going. Okay, and you've got to think about all of these things and put it in perspective, you know. Yes, there may be the odd day or two when you get a massive range and it crashes through 140, 150 pips and goes 200, 250 pips. Those days do happen, okay, but they're more the exception rather than the rule. That's why the average is what you should sort of trade to. Does that make sense to you guys? All right, so on a day trading basis, you've got the round numbers and you've got the daily range. They're levels that you really, really need to take a note of. And as you can see here, we've got an example of how the round number, the 13100 level, okay, that's on a 5-minute chart there. You can see how it reacts with that level. So even though the market will eventually break through this level, and we know that because we're now down at 121.80 or something on the euro, at that particular moment in time, if you were day trading, you know, and you're trying to sell through that level, depending on where your stop is, it's like you're in, you're out, you're in, you're out, you're in, you're out, okay? Every time you try and trade through that level. So sometimes it's better to wait for that level to be cleared and then trade when you're trading into fresh air rather than trading into a level. The daily range, as I just explained to you, is the average of the last 20 days. That's what we use. And key levels. These are big levels, okay? So the key levels are historical levels of support and resistance. They're levels where in the past you've clearly seen prices come down to that level, turned around and, you know, it's reacted to the level. And the important things about these levels, especially when you're looking at them on the daily or the weekly time frames, is that these are going to be the levels where the major institutions have their stops behind, okay? Because believe it or not, everybody uses technical analysis. Everybody uses market structure when looking at their trading decisions, and especially when trying to define risk. And those levels, just sort of behind these key levels, are where you're going to find the big stops, which is why you expect momentum when price breaks through these levels. Okay? Does that make sense? And here is an example for you guys on a daily chart of what key levels look like. Now, what you need to understand, we missed one here. This is one at the top there. That's a key level. But what you need to understand by these levels is that you shouldn't have to squint. If you're looking too hard for a level, it doesn't exist. Okay? Move on. There's another chart that's going to provide you with a more clear support and resistance levels. All right? You need levels that are very, very clear to you. So you can just take a glance at the chart and you can say, okay, I understand why that's a key level. I understand why that's a key level. I understand why that is, and so on and so forth. And you can go through the chart and you have clearly identifiable levels, and you know exactly why they've turned around at those levels. If you have to squint, if you have to second guess yourself, then it doesn't exist. Okay? Market structure. What is market jack? Market structure is basically you know, when people talk sort of like about a trending market, higher highs and higher lows, or in a downtrend, lower highs and lower lows, what the market is doing then is it's building structure. Okay, so for here, we can see that once if we take this chart here, the market's come down, it's made a high, okay? It's made a lower high and it's come down there and made a low. At this point in time, this is your structure level. At this very point in time here, when you're somewhere around this level here, this is a level that the market has to break through in order for you to be convinced that the downtrend is now finished and you now need to start looking for long opportunity. Okay, it doesn't always work out, but that's kind of the the way that you look at these things. So the structure is the lower highs and lower lows in the downtrend that sort of hold the market in place. So when we talk about trending environments, and we do our analysis for our members, and we'll say things like, okay, so we haven't made a lower high here, but until this lower low over here, for example, was taken out, we still remain bearish, because even whilst you're in a downtrend, you're not always necessarily making lower lows every single time. You may get into sort of like a corrective wave formation where you're in the ABC waves and you don't really make the lower lows, but at the same time, the lower highs, but at the same time, this lower low is keeping everything in place. You only really need to start getting concerned once that level is broken. Once that level is broken, then you start to entertain moves to the upside. But that's kind of the structure that keeps your chart in place and keeps the trend in place. So for me, in an uptrend, it's the higher lows that keep the trend in place, and in a downtrend, it's the lower highs that keeps the trend in place. Does that make sense to you? We could actually do a whole webinar on market structure, so I won't dwell on it too much here, but hopefully that kind of gives you an indication. Okay, so as you said, we're looking for trends, and trends generally emerge when price consolidates or contracts. So you always tend to go from a period of low volatility to a period of high volatility. Okay, and trends are the things that we're looking to get involved with, because they give us the higher probability setups. All right, once a strong trend is in motion, it's got a much better chance of continuing than it does reversing. Even if it goes into a period of consolidation, for example, you'd still expect the preceding trend to emerge from it rather than a reversal. Obviously, if the reversal goes on for a longer period of time, then that can give you an indication that the market is looking to go the other way. But generally speaking, you're always looking for the trend to continue. Picking tops and bottoms is great, but the majority of the time you're going to be stopping yourself out when you do that. All right. The thing that we need to understand about trends is that traders making money in a trend will continue to want to make money. All right. So it will take a long time to convince those traders, those big players in the markets, that the trend has reversed. That's why when you see reversal patterns, they can happen over weeks or months. They don't just happen over a day. When you see the market pulling back during a trend, that's not a reversal pattern. Okay, a loss of momentum doesn't signal a trend change, a trend reversal. All it signals is some profit taking, and sometimes when the markets are ultimately saying, we're taking a breather, let's see if the price accepts the current level. Once we sort of accept that this is the new fair value for the price, then we'll look to give it another leg up. Okay, so they're not always reversal patterns, and that's something you want to keep in mind, because I know a lot of people love to pick tops and bottoms, but it is a very, very quick way to go and ruin your account. So the other thing that I want you guys to do when looking at trends and support and resistance is you have to contextualize price. If you're looking at, let's say, a 4-hour chart, and this goes back to a question someone asked earlier, you're looking at a 4-hour chart, what about the daily chart? What about the weekly chart? Where are you in the grand scheme of things? It's okay saying I'm going to trade this chart blindly, and you can probably be successful doing that. But think of how much more successful you can be if you don't trade into the huge levels. So we've got a couple of examples of this. If you look at this here, this is a 1-hour chart, and you can see from the top left to the bottom right, we are in a downtrend. Does everybody see that? They accept that that's a downtrend there from the 1-hour chart. Yes? No? Maybe? Could be? Yes? Okay. Let's move along. This is the 4-hour chart. Does it still look like a huge downtrend to you? Or maybe we're starting to think to ourselves, well, might not be a downtrend, maybe going into consolidation. All right? Let's go a step back. Let's go one order of magnitude behind. That's that same price action on the daily. How's that downtrend for you now? Do we still like the downtrend? Or are we thinking that we've got momentum to the upside? Exactly. And let's take a look here. What do we have here? If I'm going to move my cursor from this area here to the right, what is that? That's resistance. Let's move to the right. Slowly, slowly. Resistance again. Slowly, slowly. Uh-oh. Previous resistance becomes support, provides the market with the ideal place to reverse and continue the trend in the direction that it just came from. Yeah, exactly. That was a retracement. That there was just a little pullback in the bigger trend. Now, I'm not saying that you can't trade the 1 hour trends or the 4 hour trends. I'm just saying be mindful of where you're trading at. So, for example, if you get a sell signal at this level here, just zoom out a little bit, take a look back. And if you look back, you'll see that by selling at that level there, you're selling into this level here. And really and truly, there are better trades that you can take than that one right there. Does that make sense? Okay. So what other sorts of levels of support and resistance can we use? Trend lines is the answer to that. Okay. We don't ever use trend lines really in isolation. We use them in conjunction with other tools. So if we can have a trend line in place with a horizontal line of support and resistance, then it makes it a lot stronger for us. Okay. So we never use them in isolation, but they are nice to help us give an indication of where price may again reverse at a later point, but we'd only use it if another horizontal line of support or resistance also appears in that sort of area. It doesn't have to be perfect, but in that area there. Okay. So when you're drawing trend lines, generally you want to connect the wicks. You don't want to cut through the bodies of candles, all right? Although you can cut through some wicks, all right? Sometimes it just makes more sense to cut through a few wicks to contain the majority of the price action than to accommodate one new spike wick that doesn't really have much meaning, all right? So you try to connect the wicks, and some parts you can cut through the wick, but you cannot cut through the body of the candle. That doesn't make any sense. If the market's managed to close below there, there's something wrong. And as I say, that can be upwards or downward sloping. This is the way you sort of draw a trend line. Okay, so as you can see here, the market is swinging up, and you would have your line connecting the wicks along the bottom. And as I said, it helps you anticipate where price may reverse in the future, because we can see that the market's come down to that trend line, it's reversed. Come down to the trend line, it's reversed. Comes back down again. Hopefully it would reverse. Now we would only look to trade that if that came in conjunction with a previous level of support or resistance. So we go to the left of the chart and we can see that that is a previous level of resistance, comes in there with the trend line. That's quite a strong level that you'd want to be taking a bounce from. Does that make sense? So how do we get into the trends? Now that we know what support and resistance is, how do we actually get back into the trade? What do we use as a tool to get into the trade to find our entry? The answer to that is two things. First of all, a counter trend line. I don't know if you guys have ever used them before. They're slightly different to trend lines. Well, they're the same object as a trend line in your chart, but you use it slightly differently. Okay, and the other one is price action, but we'll show you how you use counter trend lines here. Hold on. Okay, so as you can see here, what we're looking to do is we're looking to contain the price action of the pullback. So we're not really looking for big swings here. We're just looking for an indication of when the market is going to continue its move in the preceding trend's direction. Okay, so that's what a counter trend line does for us. So we're not looking to contain loads and loads swings of price action. We're just trying to contain the immediate price action of the pullback, and as soon as the counter trend line is broken, we're then looking to enter again. Whereas with the sloping trend line, you're connecting the wicks and you're connecting the swings. Of the counter trend line, we're just containing the pullback. Does that make sense? Now, this isn't a perfect science. It's just an indication of when the trend can continue. Does that make sense to everybody? Yes? Excellent. Okay. The other way that you can look to get into a trade off of a support or resistance level is using a reversal pattern. And our favorite sort of reversal pattern is the ABC reversal. You can use head and shoulders, double tops and double bottoms and things like that. But ultimately they all equate to sort of like an ABC reversal in one way or another. Has anybody heard of that before? 1, 2, 3 or an ABC reversal? Hopefully. Yep, excellent. Okay, so what we'd be looking for is, let's imagine, okay, the previous trend was down like this. So the big trend, the long-term trend is down. So let's say, for example, on a daily chart, that is a downtrend. And on the 4-hour chart, we are looking at a pullback, okay? And this is a previous level of support or resistance along here. All right, so this is the 4-hour chart pullback. What you would be looking for is a trend change on the 4-hour chart in the direction of the longer term time frame trend, and that is signaled by A, B, C, or 1, 2, 3, whichever way you prefer it. And what that is, okay, is a high, a low, a lower high, and once B gets broken here, what do we have? A lower low. So technically, what do we have? A downtrend. Now, what that's signaling for us is, remember that we're imagining that we're on a daily chart here, okay? So the daily chart is down. This 4-hour chart in front of you is pulling back. It's pulled back to a previous level of resistance. The 4-hour chart shows you signs that the trend is weakening. We get confirmation that it's weakened and that it could be reversing by a break of this here, of B. So we not only have a lower high, but we also have a lower low. Technically, when we have a lower low, we're into the downtrend and we're looking to short there. Does that make sense? Touch the EMA and stop halfway when it goes up. What should we do? Sometimes a counter trend does not touch the EMA. So do you mind sort of talking about that? I don't quite understand what you mean there about the EMA. We haven't spoken about EMAs in this webinar. But does everybody understand the 1, 2, 3 reversal, what we're saying there? Excellent. And as I said, it could be seen as like a leaning M or a leaning W formation. Maybe that's a little bit more old school. That's actually something that our father taught us a little while back. Ultimately, he was showing us the same thing, but he knew it was something different, which was a leaning M and leaning W. So just in case you're wondering why I referred to my father there, because you know, our family somehow are all into trading in one way or another. So hopefully it's in the DNA. Okay, guys, so that sort of brings me to the end of this webinar here, or the slides. What I'll do now is I'll open up the floor for you guys to ask any questions that you may have. Does anybody have any questions at all? Not right now? Excellent. Yep, we can look at live charts. Were you shouting there, Spin Doctor, or did you accidentally have caps lock type? Yes, indeed, they could have been lost, but it's just sort of, how do we put this? You're looking, it's increasing your strike rate. You know, you're waiting for a little bit of extra confirmation. The accuracy, you said typically our accuracy is roughly, accidentally. Okay, no problem. The accuracy that we have is around 61% for what we trade. Okay, let's look at a live chart. Would you prefer to look at a range bar chart, or would you look at a time-based chart? In fact, let me show you the perfect example of how all of this works. There was some stuff that we were trading last year. We were mentioning it in our room, and it's the dollar franc chart, daily chart. So if you just give me a second. Okay. So this is a dollar franc chart. Okay. Well, hold on. Sorry. Question. Great. This is pretty good. 1.5. Yeah, exactly. I mean, generally we get sort of like a 2-to-1 on the strike rate that we currently have. No, it doesn't go as smooth. But if you wait for the right setups, it can be. And I'm going to show you what we were talking about pretty much all of last year, when all of this was setting up. It was amazing how all of this made sense. Okay. Now last year, when we were talking with our members, we were looking at the dollar franc, and we started to see that, you know, momentum was picking up. And what ultimately we did all the way down. Okay. Where's my line? Is this. Can you see that line? Shall I make that a little bit thicker for you? Can you see that? Price breaks through the level. We expect a reversal up to the level. How would you have traded that? Trend line break, if you like. Or, we're on a daily chart there. Let's make sure that we can find this again. Go to the 4-hour chart, the same period in time. If I can find it. Am I going too far back? Bear with me here. Just so I can show you the reversal patterns at those levels. Okay. So, okay, where we put our stop. Right. So, you put your trend line break, so your stop would be above here. Okay, at 93.45. The entry, all right, so you're looking for a 1. So this would be 1 up here. 1, 2, 3. On a break of that level there, right there, 91.90, you're in there, you enter there, that's your entry, your stop is above here. If you're a little bit more aggressive, you can put your stop above there. Okay, because, you know, sort of ideally you're expecting the market to move. Once it breaks beyond that point, you're expecting momentum. If you don't get momentum, then there is the theory that you should be out of the trade anyway. So that would have been one of the examples. And then again, let's look at this chart. It was absolutely picture perfect all the way down. You get the break, bring that down there, previous level of support, breaks down, becomes resistance. And as I said, this is something that we were pointing out all last year with some of our members. This exact trade here. So I know what you mean about in practice, it's a little bit more haphazard, but this is what genuinely happened in practice. So you get a break through that level, it comes back to that level, and again you can either look for a trend line break, such as that, or you can look for the 1, 2, 3 reversal, which if I go into the chart again, I may not ever be able to find it, but we can give it a go. Go into the 4-hour. In the 4-hour, and your 1, 2, 3 reversal is that's 1 there. 0.2 breaks up, 0.3, and you're in there. And again, you've got your stop above the high, and if you're a little bit more aggressive, you've got it in there, and you would have been taken out. But swings and roundabouts, you would then look to be getting back in. I'd probably look to get back in on a break of this sort of ledge of support over here with my stop above the high. Okay, if we then go to the next opportunity of the year, and this is what I mean about being patient, because look at the time in between these trades, okay? If we were trading on a daily basis, that whole year, the time between that trade there, that's April, and that next trade over there, that was May, that's a month. And this next trade over here, this is June. Okay, so yes, there were opportunities in between, but in reality, the best opportunities, waiting for clear price action and a clear pullback, they're few and far between. But if you manage to trade these, you know, you wait for these, then they're going to make sense. On a 1-hour time frame, you wouldn't trade the same pattern on a 1-hour time frame, Harley, because it wouldn't look the same. But you could definitely look for trends on the 1-hour time frame. I mean, let's put this in here to highlight this area here, and let's go take a look at what that looked like on a 1-hour. You've got to go way back in time. Will the 1 hour take me that far back? Well, we'll use any part of the chart, so let's use this instead. On the 1-hour time frame, you're looking for exactly the same sorts of price action. So once price breaks through a level, like this would be a level that we would be looking at. Okay? Price doesn't quite get up to that level, but that would be the first thing that was in our mind. This would also be okay to trade from, because the market has clearly found support on that level before it's broken through. So something's going on at that level, and you do exactly the same thing as you were doing on the daily. You wait for the market to come up. You can either look to play sort of like a counter trend line break like that, or you can play the 1, 2, 3 reversal, or a candlestick reversal pattern if you like that as well. We personally don't really use candlestick reversal patterns, but if that's your weapon of choice, then that's not a problem either. And as you can see, you trade this all the way down. And you're just looking for the price to come up to those levels and react to those levels. You don't need them to be pip perfect, okay, because it's never ever going to be pip perfect while you're trading the FX market. There's no centralized exchange. So So you don't need it to be pip perfect, you just need it to be around about that sort of level. Does that make sense? And as you can see here, every time the market comes up to that level, it sells off. It sells off, it sells off. And using the techniques that we've given you, you should be able to identify ways to get into those trades. On the 4-hour time frame, the stop loss will be like, yep, it can be 200 pips, Jack. But stop loss isn't important because when you're trading, I'm not going to say professionally because that's not the right word for you guys at home, but if you're trading for a living, for example, then it's not going to be about the pips that you're making. It's more about the percentage of your account. So whether you're trading 150 pips, 200 pips, 400 pips, it should equal the same amount of the same percentage of your account. So all you need to do, okay, is lower your position size to enable you to take a larger stop loss. You know, and I mean, in our analysis that we do every single week, we identify these levels. In any case, we say, you know, this is where we'd expect price to get through. The downtrend is still in place until this high is broken, or so on and so forth. Gee, well, that's very, very difficult to say because the market goes through cycles. I mean, obviously there's more opportunity from a day trading perspective, but you're more in and out. On a longer term perspective, you can ride the trends for much longer. So it would be wrong to say any one particular way is more profitable than the other. I'm sorry if that seems sort of like I'm skirting around the issue, but in reality, it's not what's more profitable, it's what works best for you. I don't want to tell you that day trading is more profitable because if you can't day trade, if you can't get your head around what you need to do to day trade, it's not going to be profitable for you. Does that make sense? Exactly, Shahab. For the longer term stuff, yeah, we look through, we take a couple of things into account, Harley. We look at some of the fundamentals, we'll look at the correlations, we'll look at a whole heap of different things, but from a longer term perspective when deciding which chart to trade, because, you know, a lot of the time you can get sort of like 7, 8, 9 setups at the same time. You don't want to do that because by taking the 7, 8, 9 setups, you're not giving yourself, you're just increasing your risk because you're taking the same trade a lot of the time, but just in different pairs, or you're creating synthetic crosses and things like that. Profit target, Jack. Generally speaking, we like 2 to 1, but we like to get profits off the table before you get to the next level of resistance. So let's say, for example, we were buying here. We'd like to have some, if not all, off the table before we get to 97.39. Yeah? Yeah, the highest probability pair. So you want to sell the strongest against the weakest. No, sorry, that's wrong. Buy the strongest against the weakest. Exactly. Next resistance or support level. Any other questions? What if the market is an average? What does that mean, Shahab? Sorry, I don't quite follow. Oh, in a range. Sit on the sidelines. Don't do anything. Well, Yusuf, that's very much a personal preference. I mean, all in, all out allows you to have sort of like a predefined risk reward, which you completely understand. The problem with partial profits, okay, is a lot of the time what will happen is you'll end up taking twice the loss for your profits. Because if you think about it like this, right? If, let's say, for example, you move your stock in too close, right? So you move your stock to break even too early. You take half the position off the table, then the other half gets stopped out. That's fine, but if you don't have runners there, what you're going to end up doing is you're going to end up skewing your risk reward because you're losing 2 for every 1 you make until you let one of your partial profits run. Yes, I do. I prefer range bars to regular candles. But having said that, my brother won't move away from time-based. He uses the range charts, but he still likes to have some sort of perspective on what time means on the chart, if that makes any sense. Jack, for day trading, we trade between 8 a.m. and 11 p.m. and 1 p.m. and 4 p.m. For longer term trading, literally it doesn't matter. Time-based charts are like hourly charts, 4-hour charts, etc., etc. Thank you very much, Shahab. Hopefully we'll have more in the future. Someone just asked, Aussie dollar on the daily is an uptrend, but it's broken support. Yes, it has indeed. Well, not completely. On the daily, you're still sort of biased long, if we're honest. If you go down to the 4-hour, then you want to start possibly looking at a short. But yeah, daily, you're still really and truly, as I said, it's the lower lows that hold into place. I mean, from the daily perspective, it does look like it's going to roll over. The massive preceding trend is down, but this little micro trend that we've got going on here, you'd want to see 99.70 broken. Exactly, it does skew risk reward. Any other questions at all? Yes, exactly. Yeah, I mean, reading price action it's not even timing your entries are difficult. It's really sticking to your plan and knowing what you want to do. Because the mechanics of trading is very, very simple. You are the problem, not you, that's the wrong way to say it, but the trader is the problem. That's the hardest part to overcome. It's such a cliche, but you know, it is true. It's something that you need to overcome. Okay then guys, well thank you very much for attending this webinar today. I hope you all enjoyed it. Thank you very much. I hope so. We perhaps can do more in the future on the subject. Just very quickly, Spin Doctor, a time-based chart is based on a period of time. So every bar opens and closes after a certain period of time. A range bar chart is based on price. Okay? Thank you very much, Annie. I hope to be back soon. I think next week we're back again, if I'm not mistaken.